if we're about to have, meaning sometime later this year, an unwind that is the largest we've seen in the post-World War II era, and larger than anything we've had since the 1929 crash, then obviously capital preservation is a big statement. I mean, that's what people should be thinking about.
Thanks for joining us for part 2 of our interview with macro contrarian analyst David Hunter. If you haven't yet watched part 1 of our discussion with David, in which he gives an update on his prediction of a major melt-up in asset prices to be soon followed by a shocking market crash of 80%, all to happen this year, head over to our channel at youtube.com/Wealthion to watch it there first. It sets the context for the investment perspective that both David and our partners at New Harbor Financial share in this video. Oh, and if you haven't yet, don't forget to subscribe to this channel by clicking on the red subscribe button below, as well as that little bell icon right next to it. And now, here's part 2 of our interview with David Hunter.
I think this last stage, you might see a pretty broad rally where a lot of things participate.
Okay, so it sounds like the everything bubble, as many people call this, is going to end with everything going up. But things that you see doing particularly well are, as you said, the tech, and especially the tech leaders like the FANGs, the major industrials, the opening up companies, and obviously the precious metals and the miners. Hey, one last question on the precious metals, because I now want to talk about the bust part. A lot of people who are hearing from you and other commentators that the miners are looking particularly well positioned, and the precious metals as well. Their kind of concern of buying in right now is, well, how are they going to do when the crash happens, right? Are they going to get dragged down with the rest of the markets? And is it better just to wait and buy in later? It kind of sounds like what you're saying. I'll let you respond to that, but it kind of sounds like what you're saying is while a lot of things may really be destroyed and depressed after the correction, it seems like whatever correction there's going to be in the metals and the miners, you see relatively short-lived, given their unique role. Is that true, or am I putting false words in your mouth?
That's part of it, for sure. Part of it is really the fact that they've been such laggards. They're up. I mean, gold was 1460 in March of 2020, and it's now over 1900. So it's not like they haven't participated, but they haven't done nearly as well as the equity market, or the junk market, for example, different areas. So they're laggards that are about to catch fire, and it's so they will get hit in the bust. My guess is in the bust they'll come back to where they're just breaking out from here. So if gold, let's say, gets to 2500, it could come back to 1900. That's probably less than half, maybe that's 35-40% pullback, half of what the equity market will do in the bust. So and you're coming back to where you are now. So part of the story is that they are laggards that are just beginning to have their day in the sun. And secondly, when the bust hits, they're going to correct less than, for example, the equity markets. Silver probably is more volatile than gold in the bust, so that could correct more than gold. But basically, they're going to be relative performers in the bust. I think they're going to be significant outperformers before the bust.
Okay, great. Well, let's now get into the tactical part of the crash element. And let me preface all this by saying that none of what David's mentioning here is personal financial advice to anybody. And as we say, if you want to take action on any ideas you hear during this conference, we strongly recommend that you do that under the supervision of a professional financial advisor. But David, it sounds like potentially a good strategy if you are going long right now to capture some of this last remaining blow off top here. Maybe putting trailing stops in your positions might not be a bad idea if you're expecting that the market's going to roll over at some point in the next couple of months. Are there any other strategies that you think are worthwhile for today's regular investors to consider here? I think most people watching this, well, I think they'd love to catch, some of the upside you're talking about. They don't want to be guilty of kind of proverbially picking up nickels in front of the steamroller and putting themselves at risk of becoming collateral damage when such a big crash may happen. So what are some strategies you think are worthwhile that type of investor consider in this market environment?
Yeah, I'm going to have to say, as a strategist and not a registered investment advisor, I can't really talk specific strategies. What I can do is forecast what I think is going to come, and in a broad statement, just say that yes, if we're about to have, meaning sometime later this year, an unwind that is the largest we've seen in the post-World War II era, and larger than anything we've had since the 1929 crash, then obviously capital preservation is a big statement. I mean, that's what people should be thinking about. Everybody's got to figure out their own risk profile. So, as I've said on Twitter several times, we're in a unique period where you can cover a lot of ground in just a couple months. So to be able to say that we're maybe a couple months from a top, but 25% upside in the NASDAQ between now and that top seems contradictory. I mean, we don't usually see that kind of territory covered in that short a time. So those that are nimble probably can play the upside. Those that are not so nimble, yes, we're looking at potentially an 80% decline in the stock market and hits to most assets. The two assets that I say will stand up in the bust or in the bear market are U.S. Treasuries and the U.S. dollar, and then of course government guaranteed or insured savings accounts. So anything that's FDIC insured, the strong likelihood is that the government will fund the FDIC to whatever is necessary to cover any insurance liability. So as long as you're within the $250,000 threshold on savings, and it's an FDIC bank, you're probably safe there. And U.S. Treasuries, again, I expect the 10-year to go up to 2.5%, the 30-year up to 3% before the bust. So I'm not saying you can't lose money in treasuries here, but in the bust, I expect the 10-year to drop to 0% and the 30-year down to something under 0.5%, maybe 0.25%, as deflation takes hold and the people run to safety. So the treasuries will be one place that will hold up in the bust, and the U.S. dollar, which I'm calling for a dollar drop here from current 89.90 level down to probably 85 and maybe even down to 80 in the next few months. In the bust, I expect that to turn around and head for 120, maybe higher. So again, the dollar, not straight from here, but during the bust, will probably hold value and actually appreciate. So those are two things that will go opposite to every other asset. And maybe places where you can preserve capital. Like I said, I can't advise what people do in periods like that. I can only tell you what I expect the assets to do.
All right, I appreciate that, David, and that is super valuable insight. And for folks watching, Mike and John from New Harper and I we'll get into the details of their thoughts about how to construct a portfolio that can hedge against the type of risk that we're talking about here. All right, David, well, look, in just the couple minutes we have left, I want to end on a positive note. And I recall from our previous interview back in January that despite your predictions of a really horrific market correction, assuming it actually does happen, if I remember correctly, you're pretty optimistic about the years following in terms of economic growth and just sort of the prospects of the economy and perhaps even the markets, kind of rebuilding themselves from there. Is that still true?
That is still true. I often say what differentiates me, because I have one of the more bearish, if not the most bearish outlook for the next year on the street. But what differentiates me from some of the other gloom and doomers is some are saying we're down for the count. When we roll over from this bull market, it's over. And I'm not in that camp. I actually believe that we are this bust will probably be contained pretty much within 2022. And that from the other side, because of the ability to print money, when you're in deflation, which is what I'm calling for, the Fed has almost infinite ability, and every central bank, almost infinite ability to put money out there. That is what saves us from being, this being a depression that goes on for years. And that's why I call it a bust, to differentiate it from a depression. So therefore, it's that massive fiscal and monetary stimulus, many times what we've seen in the last 15 months. Many times that, I think, is what we're going to see in response to the bust. That will, with a lag, lead to a new cyclical bull market, not a secular bull market. So secular bull market would mean you go on to even new higher highs than we see this year. A cyclical bull market means you can have a few years where it goes up, but it'll stay below the high levels of this year. So, we're if I'm talking about 4,700 on the S&P as a top, maybe you come out of an 80% bear market and you triple. Well, an 80% bear market would take you down below 1,000. You could triple, be at 3,000, and still be well below the highs we reached this year. So that's what a cyclical bull market means, is from the bottom, you can have a lot of gains, but not necessarily get back to the previous highs, and maybe not get close to the previous highs. That's important for those that are in index funds, because if you're in an index fund that you bought at 4,500 and you ride it down to 1,000, and then it only gets back up to 3,000, you're never going to see that 4,500 again, or at least not for a long time. If your portfolio is in selected groups or stocks, the next cycle is going to be different leadership, and I expect commodity stocks to go on to major new highs. I mean, many times the highs we see this year. So certain groups, industrials and commodities in particular, including energy, I think have very big upside in the next cycle, in what, the cycle that follows the bust. It will be what I call an industrial-driven cycle, unlike what we've had for the last 40 years. In the last 40 years, it's been a consumer-driven cycle. Each of the recovery cycles have been mostly driven by consumers. Consumers 70% of the economy. Going forward, we're going to see an economy more like the 1970s, where industrials and commodity producers do extremely well. So that means those that kind of buy, let's say, the S&P index, that's going to be loaded up with all the old leaders.
They'll underperform, yeah.
And they'll underperform. So it's going to mean, for people, you're going to have to be more tactical. You're going to have to think about it, and not just buy and hold and say I'm in an index fund because indexes always do well. I think the next cycle, because of inflation, is going to be a very different story.
All right. Well, David, I hate to end it there, but we're going to have to time-wise, but super insight-rich, super fascinating. Thank you for sharing all that outlook and perspective and predictions with us. And if things follow the arc in which you are predicting, definitely want to have you back on during the bust to kind of give us the play-by-play of how you see it unfolding. But also, we can hopefully talk to you specifically then about getting even more picks on where you think the opportunity is going to lie coming out of the bust, in particular, sectors and industries. You've already done a good job here, but I presume the closer we get to that, the more zeroed in you're going to get on what looks most attractive. So, David, for folks that want to learn more and about you and your work and follow you in between now and then, where should they go?
I'm sure they can. Typically, I hang out on Twitter, so they can go to @DaveH_Contrarian is my Twitter handle. And I also put out a quarterly investment letter. It's by subscription, but if anybody's interested, there is a cost to it. But if anybody's interested, you can just direct message me on Twitter, and I'll get right back to you in terms of the details. I apologize for these kind of markets where they're moving up and they're moving down, and I know it gets confusing. We're just in that point in the cycle where there's going to be a lot of volatility.
Right. Well, and that's exactly why we need expert perspective to be able to kind of guide us through these incredibly confusing times. So David, thank you so much for sharing yours, and we look forward to having you back on the program soon.
Okay, thanks, Adam. Thanks for having me.
All right. I will now be talking with the lead partners at New Harbor Financial, the financial advisory firm endorsed by Wealthion, reacting to David's excellent and incredibly bold predictions there. All right, John and Mike, really curious to hear your guys' thoughts. David predicts a huge melt up followed by a huge, likely 80+% market correction all this year in the coming months. He sees that gold and silver are positioned to do really well. He says that he thinks tech is going to do well in this melt up, led by the FANGs again. He thinks the industrials are going to do well, all the sort of opening up, the economy opening up types of businesses, airlines, railways, et cetera, during this remaining gasp of the melt up. And then, of course, we potentially have a massive stock market crash. So, John, let's start with you. What do you take away from David's courageous predictions?
Yeah, I mean, his projections are certainly specific and time bound, and we'll see how eerily precise or not they are. But
that's a big risk to take.
Yeah, no, and he's got a long tenure in this industry, so he's definitely got plenty of perspective and experience to back up some degree of bold call making. Our approach, or our role as financial advisors to individuals and families, we're not in the business of prognosticating specific targets, because that frankly misses the point for most people. Most people don't and shouldn't think of their investment plan, their financial plan as, making sure they get every basis point of upside in a market. And, because what really matters to most people, or should, is that they have financially secure lives. And in that regard, we need to kind of really emphasize what's at stake for clients. If you take, David's, projections at face value, basically as of like a week ago, his target for the S&P 500 was about 11% higher. It's actually a little lower than that now, given the market's been up a little bit since then. But if someone were to want to gamble and kind of stay in the market fully invested with the expectation of that upside target being realized, and then happen to sit through the 80% decline that David is projecting, that would be a round trip return of negative 78%. Effectively any upside from here would likely just be absolutely dwarfed by any materialization of David's downside target. The idea of picking up pennies in front of a steamroller really is a good visual. Even if we assume there's tremendous upside from current levels, which almost no one can make that case, right? But let's just play with some numbers here. If we assume that the market had 80% upside from this current level, but then suffered an 80% decline, because of the way compound math works, an 80% move higher from current levels followed by an 80% decline would still be a round trip return of negative 64%. All to say is that, all well and good to think about a melt up scenario, but what it means for most people is you better be darn precise on the timing of getting out, because the sell-off that many strategists, David himself included, are projecting would likely go way more to wipe out any benefit of being in a melt-up phase if one were occur from these levels.
Very wisely said there, John. I think a lot of people don't intuitively understand that math. And so while David does think the markets could go materially higher here in the next month or two, I think your pennies in front of the steamroller analogy is an appropriate one. And I think people need to be planning much more for the potential of an 80% market correction than they do trying to pick up a few more gains, in the next couple of months here. Because again, folks, nobody has a crystal ball here. Maybe the correction arrives, maybe it doesn't, maybe the melt up happens, maybe it doesn't. But if there is, in your mind, after listening to David, a credible potential of a correction of that magnitude coming this year, that really, I think, needs to be on most prudent investors' top priority list, which is how do I make sure that my wealth doesn't get destroyed during, a correction of that magnitude. Mike, I just want to talk to you real briefly. Again, anything you want to add to what John said, but one of the reasons why Wealthion has struck this relationship with you guys at New Harbor is because of your expertise in risk management. And I got to imagine hearing a guy like David, who's had a fair amount of success and a good, long track record as a market forecaster, hearing the potential for an 80% market correction in the next couple of months, that's really got to set your warning bells off, but also put your gears, mental gears in place of, okay, this is how we're going to try to protect against something like that. So if you can please in your answer sort of just talk to your guys' current risk mitigation strategy for that type of correction, I think folks would be really interested in hearing it.
Sure, Adam, thank you. Yeah, the key part of David Hunter's prediction that's very dangerous for everybody is the minus 80% part. Heck, even if the market drops 50%, it's going to wipe out a lot of people. The market here is at about 4,200 on the S&P. Even if the market went up to 5 or 6 or 7,000 and only lost 50%, if it went to 7,000 and then lost 50%, that would bring it back to 3,500, which is a good, almost 20% down from here. Very few people will get out anywhere near the top if we have that kind of parabolic move even higher from here. It's just the parabolic moves have historically shown to be more like needlepoint moves. They reverse quickly. And they reverse so quickly that it feels like, well, it's silly to get out now after after a quick 20% drop. I'll just wait till it gets back to where it was, then I'll sell. Well, that never happens. Guaranteed, most people will get trapped in that type of scenario. And it's the minus 50 to minus 80% drop that will wipe people out. Just looking at the numbers, we could go to 10,000 on the S&P and then lose 80%. That would bring us down to 2,000, which is over 50% lower from here. So that kind of volatility, that type of crushing loss will just be devastating no matter how high we go. And, it's sad that that's the world we're living in. That's the kind of world that central banking has created. In the end, everyone gets hurt. And in terms of how we're navigating it, we're choosing to not try to pick the top by keeping a heavy cash buffer. And so we're happy to plod along slowly with, small, positive returns. But in exchange for that, we don't want to have much downside capture. And we don't have much downside capture. Last year, when the market was down over 30%, we were roughly flat, maybe even up 1%. We're proud of that, and we hope to do that type of thing again. It's difficult because central banking policy is just focused on getting everyone psychologically, very uncomfortable. People have FOMO; they want to get in. That's what causes these types of parabolic tops. So our strategy is basically to not try to call the top. We don't think anyone can. And even if you can stay in and have some have some gains from here, most people are going to get really wiped out on the backside. Furthermore, the really dangerous thing is going to be trying to pick a bottom on the backside. We've been so conditioned to buy the dip hundreds and hundreds of times now over the last 10 to 12 years. Every single dip has been reversed, almost vertically, by central bank policy. It's going to feel like the right thing to do it again. And you could easily lose a lot more by adding more and more and more every time the market dips and then fails to bounce than you would otherwise just kind of staying in for the whole ride. So our strategy at New Harbor, I think, is pretty unique in that we use options to layer into a market that's declining. And usually a market that is declining has increasing volatility. And it allows us to sell options into that volatility and give us a more balanced and hedged way to enter. We don't know when the ultimate bottom will be, but I can tell you that we'll be earning premium along the way and increasing exposure as the market drops. I think it's the strategy that almost more than any other will be best suited to handle the market like that. So that's our plan.
All right, Mike, thanks so much for laying that out. And so the main point I want to make for folks here is whether this is the first Wealthion video you've watched or it's the 20th, if the risks that David were talking about resonated with you and you think that there is a material enough probability of a correction of the size that he's predicting here in the very near future, you really do, like, now is the time to take action, right? This is one of those things where it's better to be months early, even a year early, than a day late if there's this type of correction coming up here. People, I think, have already largely forgotten the losses they briefly took last year when the market swooned in late February, early March. And I can tell you, Mike mentioned there was a period there where the general markets were down 35%, New Harbor was up by 1%. There were so many people knocking on our door asking if they could, get into the New Harbor portfolio, but kicking themselves that they had delayed and had lost a third of their portfolio in the matter of just a couple of days in the market. So this is the type of thing that if you think a magnitude of drop of this level could potentially happen, you really need to come up with your strategy for it now. So again, highly recommend you work with a professional financial advisor to guide you in this. If you've already got a good one, fantastic, stick with them. Just make sure that they're aware of the risks that David talked about. If you don't have a good one or having trouble finding one, talk to Mike and John and the team at New Harbor. As I mention every week on these programs, they do this for free with no strings attached. They are happy to give a financial consultation to anybody watching this video who wants to figure out if they could be better positioned than they are today for what might be coming here that David's talking about. So if I sound like I'm sort of pounding on the table here, it's just that if David turns out to be correct, and who knows, time will tell, but if he does, it's the steps you take today that are going to determine how well you fare in that eventuality. All right, John and Mike, thanks so much for joining me again this week, guys. Again, what a great presentation from David Hunter there. Now, folks watching, we also have a live Q&A from the conference with Dave, and I'm going to tell you how to get your hands on that for free too. I hope you've enjoyed this thought-provoking interview with macro contrarian analyst David Hunter. As we wrap up here, folks, I'd just like to direct your attention to two valuable free resources. The first is the free consultations offered by John and Mike and the team at New Harbor. If David's predictions turn out to be correct, there is very little remaining time left to get prepared. You need to use that time wisely. So if you aren't already working with a good professional financial advisor who at least understands the concerns that David is voicing here, then take 20 seconds right now and fill out the short form over at Wealthion.com and schedule a portfolio review. It's free, there are no obligations involved, and you'll get answers specific to your unique personal financial situation, needs, and goals. Okay, and as for valuable resource number 2, at our conference, David was gracious enough to field 20 minutes of audience Q&A after making this presentation. Hearing him defend and expand upon the bold predictions that he makes really clarifies and drives home the logic underlying them. So to watch a free video of David's Q&A session, just go over to Wealthion.com/Hunter. Thanks for watching. If you'd like to schedule a consultation with one of the financial advisors at New Harbor Financial, simply go to Wealthion.com. These consultations are completely free and there are no strings attached. The good folks at New Harbor will simply answer any questions you have about your investment goals or your portfolio and give you their best advice given their latest market outlook. They're willing to do this because they care about protecting people's wealth, and because Wealthion has connected them with so many thoughtful investors just like you over the past decade. We started doing this because so many people have approached us in frustration, looking for a solution because they're feeling out of alignment or downright ridiculed by the standard financial advisors who have been managing their money. You know the type. The kind that just pushes all of your money into the market, scoffs at the idea of owning gold, and when you bring up concerns about the market's sky-high valuations, they say, "Don't worry, the market will always take care of you." For many of the reasons discussed in today's video, we think this is one of the most challenging and treacherous times in history for investing. We strongly believe that today's investors are best served working in partnership with a conscientious professional financial advisor who understands the risks in play. Now, we're agnostic which professional advisor you work with, as long as they're good. If you're already working with one, that's fantastic. Stick with them. But if you don't, or are having trouble finding one you respect or trust, then consider talking to John and Mike and the team at New Harbor. Now, for those about to ask, yes, there's a business relationship between Wealthion and New Harbor, which we've put in place to make sure everything is handled according to SEC regulations. All the details on this are clearly provided on the Wealthion.com website. Also, it's important to note that New Harbor is able to work with U.S. citizens, green card holders, and those with existing assets in the USA. But for regulatory reasons, they aren't able to take on non-U.S. clients. All right, with all that said, if you'd like some insight and guidance on how to protect your wealth during this unprecedented time in the markets, go to Wealthion.com to schedule your free consultation with the good folks at New Harbor. Thanks for watching.